Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, March 23rd, and today's theme is simple. Oil is yelling, rates are listening, and portfolios are reconsidering their life choices.
I love when the market wakes up and chooses chaos. If oil is yelling, my budget is whispering, please stop. What are we hitting first? Gas, gold, or crypto drama?
All three, efficiently. We'll cover oil spiking on Strait of Hormuz risk, gold sliding to a 4-month low as rate hike bets rise, the dollar hitting a fresh 2026 high, and a crypto week ahead checklist.
Okay, explain it like I'm 5, but a 5-year-old with a brokerage app. Why does one shipping lane make everyone act like their mortgage rate is about to jump?
Because energy is the economy's universal input. CNBC flagged oil rising with markets on edge over a prolonged disruption risk around the Strait of Hormuz. If oil stays high, inflation expectations rise, central banks get less flexible, and bond yields can climb.
So it's basically the world's delivery fee goes up, and then the Fed is like, cool, now everyone pays more for money too. Love that for us.
That's the grim poetry. An SCMP reported traders projecting no Fed cuts this year after comments that rising oil adds uncertainty. When rate cuts get priced out, risk assets tend to wobble. Stocks, high-yield credit, long-duration tech.
I'm going to disagree slightly. People always say, just hedge with energy. But when you're a normal person, buying an oil ETF feels like trying to fight a kitchen fire by investing in matches.
Fair pushback. A hedge isn't a personality. For most households, the first hedge is cash flow resilience. Build a buffer, reduce variable rate debt exposure, and avoid panic trades. If you do hedge, keep it small and rules-based.
Now the part that broke my brain. Channel News Asia says gold dove to a 4-month low as inflation pressures lift rate hike bets. Isn't gold supposed to love fear? Did gold forget its job description?
Gold loves fear, but it hates two things more: a stronger dollar and higher real yields. If markets think central banks might tighten, yields can rise, and the opportunity cost of holding non-yielding gold goes up.
So gold is like, I'm a safe haven. But then rates walk in and gold goes, actually, I have plans. That is the fleekiest asset behavior I've ever seen.
It's not flaky, it's conditional. In a crisis where liquidity is king, people sell what they can to raise cash. Plus, if inflation fear translates into higher for longer, gold can dip short-term even if the long-term hedge thesis remains.
Speaking of king, Bloomberg says the dollar hit a fresh 2026 high with the war entering its 4th week. Strong dollar, good for my vacation, bad for basically everyone else.
Good for Americans buying imports and traveling, yes, but it can pressure U.S. multinationals' overseas earnings when translated back to dollars, and it tightens financial conditions globally, especially for borrowers with dollar-denominated debt.
So the dollar is doing that thing where it gets strong, and suddenly the rest of the world is like, who invited this guy? Okay, what's the practical move for listeners?
3-bucket plan. 1. Protect near-term needs, 3 to 6 months of expenses, and don't let variable rate debt balloon. 2. Keep core investing boring. Broad diversification, avoid over-concentrating in the most rate-sensitive names. 3. If you must hedge, size it so you can sleep. Small energy exposure or inflation-protected instruments, not a full portfolio makeover.
All right, Crypto Corner. CoinDesk's Crypto Week Ahead mentions Fed's Mirren speaking, BitGo earnings, and a Casper hard fork. Translation? My timeline will be unbearable by Tuesday?
Likely. For crypto, macro plus event risk matters. A Fed speaker can move rates expectations. That hits liquidity. Earnings can reprice a sector narrative. And a hard fork is like swapping the engine mid-flight. Usually planned, but it can create volatility around execution risk.
Here's my disagreement. People treat every fork like it's a guaranteed number go up. Sometimes it's just software maintenance with a marketing budget.
I'm with you. Maintenance isn't a catalyst by itself. The actionable checklist: reduce leverage, know your liquidity windows, set downside levels before the speech and before the fork, and avoid confusing a one-day bounce with a trend.
So today's vibe is oil risk makes rates scary, Rates make gold sad, dollar gets strong, and crypto gets loud. I hate how coherent that is.
Recap in one breath. Hormuz-driven oil volatility is feeding inflation fears. Markets are repricing toward tighter policy, gold is sliding under the weight of yields in the dollar, and crypto has a catalyst-heavy week. If this helped, subscribe and drop a comment. Are you hedging energy risk or simply de-risking?
And if you're making big moves today, remember, small and survivable beats bold and regrettable. See you next episode.